Let's get back to the market move this morning. Investors seem a bit cautious as we begin a new month of trading, but there has been plenty of momentum behind stocks. The S&P 500 is actually moving back towards its all-time highs. Kristen Bitterly is head of investments for North America at Citi Global Wealth, and she joins us with her assessment of the markets. Great to have you with us, Kristen. Thanks very much for your time.
Great to see you. Thanks for having me.
Let's start with the economic assessment, because we just had a conversation with the former Bank of Canada governor who painted a relatively upbeat picture of slower growth, but less recessionary talk than maybe we might have been hearing a month ago. And even looking at the S&P 500 with another monthly advance, a lot of investors were talking about the soft landing so-called scenario possibly emerging for the U.S. economy. What's been your assessment of how the markets are digesting all the data right now?
I would actually agree with his comments, this concept of slower growth, and that certainly the probability of a soft landing has increased over the past couple of months. I think there's a couple of key reasons for that. When we look at the resiliency of the economic data coming out of the U.S., the recent GDP print that we saw, we continue to see resilient growth from an economic perspective. We've also seen inflation come down. And when you look at areas, for example, like services ex shelter coming down from a high of 8% down to 3%, that is definitely going in the right direction, not at the Fed's target, but certainly another thing that the market seems to be applauding. And the last piece, which I think is important, is in our latest commentary from Chair Powell, we seem to have a more rational Fed who's acknowledging that we have seen inflation come down. They continue to be data dependent, but they're not going to have to be sufficiently or too much in terms of their restrictive policy to lead to a recession. So I think when you combine those three things, it leads to some support for the market at these levels.
And Kristen, let's add in another variable, which is what companies themselves are saying. And I think that there was this anticipation that businesses would be more cost conscious and that might help their bottom line performance. But there have even been some indications that in terms of the sales picture, things are still relatively strong for these businesses. We've got to choose these words carefully because it's always versus the expectations. But at the end of the day, when you look at companies and what they've been saying, we're in the heat of earnings season right now. What are some of your takeaways?
Yeah, so what I would say is I think we continue to see resilient earnings as well. I think, look, Q2 in terms of a decline that we have seen and was largely anticipated. I think another thing that's very interesting about the market dynamics, and one of the things that we did not discuss at the beginning of this year, is the concept of when we're talking about whether it's slowing growth or a recessionary environment, this idea that we could actually, instead of seeing something contract all at once, what we could be seeing is what we're calling a rolling recession. If we go back to Q4 of last year, we had 7 out of 11 of the sectors already in profits recession. We saw the same thing in Q1. And in Q2 of this year, while we're seeing some resiliency, we do see 6 out of the 11 sectors in a profits recession. So we are seeing the impact of that tightening. We are seeing the impact in terms of some pockets of the market in contractionary environments, but it's not everything all at once, which is why I think we're seeing some of the resiliency in terms of the overall index level and also the probability of what we could see to be a soft landing.
Interesting to hear you say in those terms. A generally bullish Wall Street player, Ed Yardeni, had talked about a period of rolling recessions. He's now talking about a rolling recovery. And I know that in our specific conversations with you this year, you had always asked the question of the value of money in equities versus other areas. I know there was a lot of uncertainty coming into the year, and obviously there's been some favorable terms for investors given the increase in interest rates in, cash-like products, some shorter dated securities. But here we are, the S&P 500, I think is up like 20% this year. You've got the TSX in Toronto, which is up about 6.5%. There's some challenges within certain sectors within that performance, but the idea of not being invested in the market obviously is something that investors are now thinking a lot more about, so much so that you've got some of these strategists that are playing catch up. What would you say about sort of the allocation of one's portfolio at this stage of the game?
I think if the first half of this year and even what we experienced last year, if it's taught us anything, it's this it's impossible to time the market, and that there's a lot of value and power in staying invested. As you know, in our conversations that we've had over the course of this year, coming into 2023, we were defensively positioned. We were overweight fixed income relative to equities. Within our equities allocation, we definitely favored some of the strong free cash flow generating companies out there. But even when you look at a diversified portfolio, so let's take a look at a 60-40 portfolio, has returned in excess of 10% year to date. So if you were someone who was hanging out in pure cash, you would have been up around 2, maybe 2.1%. If you're in a diversified, relatively conservative portfolio, you're still returning double digits for effectively the first half of this year. So I think even though we talk a lot about the Magnificent Seven, we've talked a lot about those extreme returns that we've seen within tech stocks fueled by AI, an investor who had the discipline to stay invested, even if it was relatively conservative from a positioning standpoint, still saw very strong returns for the first half of this year. And I think that's another thing that is continuing a lot of our advice and a lot of our thought process as to how to approach the next several months as well.
So a final thought on that. We've only got about 30 seconds, Kristen, but the TSX overall performance leans heavily on sectors like financials and materials and energy. Energy is still negative on the year, even though oil just had a very strong month. What do you think about the makeup of a market like the Canadian market versus the S&P in these final months of 2023?
Yeah, I think when you look at sectors like energy and financials, from our perspective, looking at some of the challenges with a higher interest rate environment overall, well, there certainly could be some tactical recoveries and some appreciation there. It's something when we look at more of our overall portfolio positioning and where we've been adding exposure, where we see value, we certainly see value in terms of the international discount compared to the US market, with international equities trading at around a 40% discount. And we also see with this broadening of the rally, looking at profitability within small and mid cap shares. So if you're asking the question as to where we could see some of this catch up playing, those would be our preferred areas. I think we're still cautious in terms of some of the, whether it's interest rate sensitive sectors or capital intensive sectors.
Got it.